So, okay, guys, I had some other important concepts to cover for myself also, so might as well make a video on it. So, this will be a quick video. The first one to cover is the AMC code or the Asset Manager code. So, some important points. There are six key components on which the AMC is laid on. First is the loyalty to the clients. It's common. We have read this across the CFA ethics chapter. So, clients' interest first, confidentiality, no compromise on objectivity, investment process, fair dealing, no manipulation, reasonable bias, trading, no manipulation, no front running, use of soft dollars for client benefits, risk management or compliance, have good compliance offers, have an external audit, record retention, have a qualified staff, performance and valuation, fair and accurate data, recommend to adopt GIPS and use fair valuation. In terms of disclosure, timely communication to the customers, fees, cost disclosure, valuation methods, and the risk management followed by the firm. Next is the GIPS overview. So before getting into the GIPS overview, let me tell you this is a very brief slide and it is only for the last minute revision. I recommend you to read the chapters. I have not read myself, but I'm recommending you guys. Okay, so in terms of compliance, compliance can be claimed only by management firms, not by individuals. All fee paying discretionary portfolios should be assigned at least one composite. Historical composite returns should not be altered. If there are any conflicts with local regulations, follow the local regulation but disclose the conflicts. GIPS standards requires firm to show minimum 5 years of investment performance, and thereafter, once they grow up to 10 years, they have to show up to 10 years of reported performance, and they are not required to make negative assurance statements like they are using leverage or they are using derivatives. Such kind of information is not required. In terms of input data, after 2010, the portfolio should be measured at fair value. Trade accounting is required throughout after 2005. Valuation timings before 2001 quarterly, after 2001 monthly, beginning 2010 on on the date of large cash flows or in each calendar month end. Why this large cash flows? Because a portfolio can behave or show a big return or a big loss in terms of in case there is a subscription or redemption from the portfolio. So the cash goes out or the cash comes in and when it's quite large, it will affect the portfolio performance. Portfolio must not be valued on cherry picking basis. That means based on your whims and fancies. It should be done based on the valuation timings, which is monthly, quarterly before 2001, and monthly after 2001. In terms of input data calculation methodologies, its TWRR is required. So beginning 2005 used the DIETS method, which is simply ending value minus starting value minus the cash flow received. This could be dividends divided by the starting value plus cash flow into zero point 0.5. And after 2005, before 2005 it was original DIETS method, and beginning 2005 it's a modified DIETS method. The only modification is the sum of cash flow into the weight, and W is the proportion of days the cash flow has been included. It's very simple. Cash returns must be included in the portfolio performance. Cash allocation has greater effect on portfolio returns than selecting short-term investments. All cash returns, all those portfolios having cash balances should also be reported, and their returns should also be reported because there could be a cash drag on the portfolio. All trading expenses must be included in the return performance. Custody fees should not be included because custody fees is something that you pay to the custodian to maintain the record of your securities or to settle on their behalf, but it's not a trading expense. Rules for composite constructions. If restrictions prevent an investment strategy from being implemented as intended, if there are restrictions on the portfolio creation, then it may be termed as a non-discretionary because the portfolio manager does not have any control over the portfolio because of the restrictions. Composites cannot include modeled portfolio, but they can be showed as a supplemental info as a appendix, but should not be linked to the original portfolio performance. Terminated portfolio should omit returns the month when they are terminated. For example, If trading has stopped in a portfolio on April 20 up till March, the reporting should be done. Meaning, beginning 2010, carve outs can't be used in composites unless managed separately with its own cash balance. If a carve out is included before 2010, it must be disclosed. Carve out is a spin off or separation of a portfolio. And this is the exhaustive list of GIPS disclosure requirements. You just have to memorize this. Define the firm, define the significant events, that how many sub advisors are used, or if any key manager has left the firm. What is the composite creation date, minimum asset level and carve out info. What are the valuation policies that are followed, and what is the internal dispersion measurement. Beginning 2011, firms must disclose each annual period end 3-year annualized standard deviation. Beginning 2011, firm must disclose 3-year annual standard deviation. And if standard deviation is not useful for the firm, so if it's a private equity firm, so standard deviation might not be that applicable. So in that case, they might use another method, but they have to disclose it. What is the fee and the fee schedule? The number of portfolios list unless five or few. So if you are having less than five portfolios, you may not want to list it. Composite and firm assets. What is the firm assets that the firm is managing? What is the gross of fee returns and the net of fee return? So very basic things in terms of investment management, but you have to remember this. In terms of private equity and real estate, there are some terms that you need to remember. Committed capital, we know that is the amount committed to the general partner, and paid in capital is the sum of all the committed capital that has been called. TVPI is also known as the investment multiple. That is, it is the total value of the sum of distributions and in the end of period residual value. So, how much return you have got on your investment? How much return you have got on your investment? The distribution based on your paid in capital. DPC is also called the realization multiple. DPC is distributions to paid up capital. Total value is the sum of distributions and end of period residual value also. So there is, so suppose you have a fund which is giving you 4% dividend every year, but there is some capital also left in that fund. So that capital also gets added in the total value, but in the DPC only the dividends are added. Paid in capital to committed capital is simply how much you have already paid to the general partner divided by the total committed capital, and residually obviously whatever is distributed is already realized, and the unrealized multiple is known as the residual value to paid in capital, RVPI. Some important concepts. So I had used a manual way to explain this because I thought this is a better way to explain this. So in variance swaps, in the derivatives and currency management chapter, there is a topic called variance swaps. I've just tried to make it very simple. So a notional amount of a variance swap is known, can be bifurcated as variance notional and vega notional. So vega is the term that is common to the option terminology. So we'll use vega notional as the base concept. Profit and loss of the variance is the variance notional into standard deviation minus k square. What is standard deviation? Is the realized volatility, and what is k square is the implied or the strike volatility. The k is the strike, that is the implied volatility, and standard deviation is the actual realized volatility. PNL is equal to n vega standard deviation square minus k square upon 2k. If you see over here, the nvar was already available. So in essence, nvar and n vega will have different formulas. You have to remember both of them. So these are the important formulas that you need to remember. Now let us take an example from the book that is given. I'll try to make it easy. So here is a swap that we have entered on 0 day, and 3 months have expired since the swap was entered into, and 9 months are left. So T is 3 because that is a duration which has expired, and the capital T minus T is the residual value, which is 9 months. So expected variance at maturity. What are we doing over here? We are valuing our variance swap at this point. So if I want to do MTM, the formula is simple. The first step is to value the swap. So to value the swap, the formula is very simple. You have to just use your standard deviation into T, that is the time elapsed, upon the total time. Similarly for the K square, what is the time remaining? For this, the elapsed time was T because this is realized. So this is T. Look back over here. This is the realized volatility. So it will refer to the past. This is the implied volatility. So this will look at the future. That is T minus T. Got it? So that's one way to remember this. Let's take an example. The Vega notional is 100,000. It's not visible over here, but it's 100,000. It's 100,000, the Vega notional. And after 9 months, standard deviation is 21 and implied volatility is 22. So what is the expected variance? So expected variance, we plug in this formula. Simply 21 square into 9 by 2. The 9 months have gone and the remaining is 3. So 3 by 12. So this is 451.75. And what is the expected payoff at maturity? So we go back to this formula. We go back to this formula. What is the Vega notional which is given? Vega notional is given as 100,000. So 100,000 upon 2k into standard deviation square minus k square. So standard deviation square we have computed in the first step, which is 451.75, and k is 20, that is given in the sum, strike off 20. So this way we get the value of 129.375. You simply discount it by the remaining period. How much period is remaining? So 9 months have expired. Out of 12, 3 months is remaining. So this is a proportionate interest rate, and you just discount the swap notional at 1.05. So you get this value. So important things to remember over here is this formula. This is the main formula. The result of this formula will form the expected variance, which is this part, and k is already given over here as 20. So this way you can remember this. Not that intuitive way, but if you pause the video and look at the sum in the book, you might be able to correlate. Another important thing that I've found in the mocks is the Fed fund rates example. So it's very simple in that sense. So you have to compute what is the probability of the rate change. So in the next meeting, when the Fed is meeting, will they change the rate to target the inflation, or they won't change the rate? So what is the probability? So the formula says that the effective rate implied by futures minus current target rate upon change in rate the Fed rate assuming the rate change minus current target rate. So I was having a lot of difficulty to remember this, so I've created a shortcut. You can simply say F minus C upon A minus C, and for the exam you can remember FC upon AC. So in that way you can remember it's FC upon AC. So C remains same. So C is the current target rate. F is a rate implied by futures, and A is assumption based rate change. Assumption based rate change. Alternatively, it can be written as such expected size of rate change, because this mathematically means expected size of rate change. This remains the same. This remains the same. So FC remains the same over here. So in the example in the book, the futures rate is written as. I'll just compute this in an Excel. It's simpler. So the rate is 98.1625, I think so. Yeah. And the target inflation is 1.5 to 1.75. Change probability is 25 bips, so we'll say 0.25 percentage. You have to refer to the books, the example in the book. So this is the Fed futures rate. Fed futures rate. This is the lower bound of the interest rate. This is the upper bound of the interest rate, of the target interest rate, of the target rate, and this is the rate change in BPS. So first, what we have to find from the concept FC. So what is F? F is 100 minus this. So I'll have to take it in percentage term. I'll just put a percentage in front of it. It's 1.835 percentage. And what is the second term? Is the C. C is the term which is current target rate. So current target rate is given as two rates. So we will take an average of both as a midpoint. Average of both is 1.625. And what is the rate change? Rate change is given as 0.25 from here. Okay. So what is our formula? We have two formula, FC, AC. So F minus C, A minus C. Over here we don't have the A component. Over here we don't have the A component. So we'll use the second formula, F minus C upon rate change. So what is F? F is simply 1.8375. C is this, and this divided by 0.25. In terms of percentage, 85%. 85% is the probability of rate change. So you get 85% over here. So just wanted to conclude these two sums also. These are very important concepts. Some important marks that I've lost in my mock exams, maybe because of these important points. Thank you.